Now, senior bank regulators from leading economies are expected to agree new rules on Sunday aimed at reducing the risk of a future financial crisis. Meeting in the Swiss city of Basel, the regulators hope that the reforms will help banks and other lenders to cope better when borrowers default on loan repayments in large numbers. Well, our business correspondent Joe Lynam is here and can tell us more. Joe.
Yeah, no, this is a very important meeting, even though there's no cameras at the event. Basically, the club of the top regulators, including Mervyn King from the Bank of England and the Fed chairman and all that, they're all at this meeting to decide the rules by which banks should play going forward. Now, why is that important? Because 2 years ago, exactly 2 years ago, the entire banking system nearly collapsed. We were hours away from that happening. And as a result, taxpayers had to step in and bail out so many banks. In this country, we saw, of course, Northern Rock and RBS and HBOS, Lloyd's Group as well. That happened, that was replicated in most of the Western world, and the reason that happened is because they didn't have enough capital. That is the reserve cushion of cash set aside for the rainy day, and it was lashing 2 years ago, and they didn't have enough money, so the taxpayer had to step in. So what they're going to do is raise that cushion of cash, raise the bar of solid core tier 1 capital. That's the technical term. So if it does start raining, they dip into their own reserves rather than go cap in hand, bowl or hat in hand to the taxpayer.
So can this prevent another financial crisis? Is it really that simple?
Well, you can never really prevent the next crisis because you don't know how the next crisis will come along. What it hopes to do is prevent taxpayers being on the hook like they have been for the last few years by setting aside this core tier 1 capital. But there's a row going on between the banks that have already been recapitalised, British, Swiss, American banks, and the banks that need further more money, and they are German, French and Italian banks. The problem is, if you raise the bar so high that banks need to go back to their shareholders for more money, they may not have money to lend to you and me or to small companies and such like. So it's a balancing act that they have to go. You don't want to raise it to make it too tough for the banks, but you have to make it tough so they've learned the lesson from 2 years ago. That's the real lesson here.
So what kind of impact will it have in Britain? Because this doesn't actually involve British banks, does it?
Well, it will, of course, involve British banks, but they are already well capitalised. The main British banks, the top 5 banks in this country, have been recapitalised, and the amount of money they've set aside is 10% based on this core tier 1 ratio that we're talking about. So in other words, for every £10 lent out, they have £1 tucked away for that rainy day. The new rules will raise it to about 7%, which means for every £100 lent out, they will have 7 really good pounds set aside for that rainy day. And that will apply across the board. But the bar is already much higher in Britain, so it won't necessarily have an impact here. It will have an effect in Germany and France and Italy. And German banks probably will have to go back to their existing shareholders in the next couple of years looking for about €100 billion. That's a lot of money.